Welcome back guys to another Zero DTE video, and today Ernie's going to talk about credit spreads and naked puts, so stay tuned for that. If you're interested in becoming a pro trader, check out the link in the description for a 4-week trial, and as always guys, enjoy.
Now, the way most people play premium collection is with what's called a naked put. That's where you sell a put. Now, when you sell a put, that's a directional trade, more or less. It's saying that you're bullish on the market. You hope that price stays about the same or goes in your direction. Now, let's take a look at what that looks like. Let's first draw the risk graph. So this would be plus, this would be minus, and this is your zero line. Let's say that price is right here. Now, when you put on a naked put, you're selling a put. And when you sell a put, it's going to look something like this. Now, let's say that the strike price that you want is right at the money, right there. Probably not the best way to do it, but your risk graph is going to look something like this. So you're going to be sitting outside, and you need to get inside here, because that's where the profit lies. That means that you need price to go this way, bullish a little bit, until it gets to a point where it's break even. This break even point is the point where you overcome the risk. Now, the premium, when you first get into a trade like this, is going to look something like this, right? So cyan line is your intrinsic value. The magenta line, that's your extrinsic value. So when you get in, what you're hoping for is that you're going to move into your profit tent, and you're going to make this right here. Of course, if you're outside here, you're not going to make anything. So this is like a no-go right here. So what you want to do is you want to take that trade when you're inside the profit tent. So a trade like this should really be set up like that. You want to start on the inside and take a strike price out here. Right? Because if you take a strike price out here, now your profit looks like this. So now, as a seller of this put, this is a short put. Eventually, what's going to happen is this premium line is going to decay and then turn into this at expiration. This is the contract terms that you have in a put. You're sitting right here. It's also your real-time profit line. So if price goes up or goes down, you follow that purple line. So let's say price goes down to here before expiration. You're like 10 o'clock in the morning. You're down. You're in the negative, maybe down $100. If it moves up, you're up maybe $100. Now, if you're lucky and you stay, say, here or anywhere inside of this point right here, the break-even point, this line is going to continue going up, and that represents your profit until it fills up here. And then if you stay inside, you could potentially make that full amount. Let's say it's $500. That's great. That's selling a put to ensure that you're going to make some money by either going down a little bit, staying the same, or going in this direction. So you make money whether you go this way a little bit, but you also make it if you just stay right there. That's pretty cool. The only problem with this here is this part, the unlimited risk. And it's not really unlimited, but for all practical purposes, it is unlimited, because the risk is the risk that the asset that you're going to trade is going to go to zero. Now, there's probably not a good chance of that happening. There's probably no chance of that happening, but it's still a significant risk, and it could wipe out your account for sure. So there's the most basic premium collection strategy. Now, there's a lot of other ways to collect premium and ways that you can reduce your risk. Like a lot of people put on credit spreads. Like a put credit spread would look something like this. It almost looks like the regular naked put, but not quite. Basically, two spreads. Let's say that you get in right there. And then with this, the premium part looks like this. Now, the nice thing about this is that it has limited risk. However, the amount that you have here is much less than just a naked put. Maybe instead of 500, it's only 200. However, now maybe you've reduced your risk to only 200 instead of being unlimited. All right, it's a better trade. You have a better risk to reward. In this case, your risk to reward is 1-to-1. So you have a 50-50 chance. The problem is that price needs to either stay here, has to stay somewhere between here and here, or here if you want to get the maximum amount of profit. Here would be break even. But as soon as you get into that trade, if you start moving this way, you can see that that real-time profit line will affect you. So if you move and price goes down, even though you can potentially have profit if you wait until the end of the day, you have this to contend with and the possibility of having a big loss. So that's the real problem with any of these type of trades.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.